Good day, fellow investors. Saba sent me this great comment explaining what is ahead when it comes to the current bear market. And I want to give you 3 factors explaining what is the most probable outcome when it comes to the current bear market and how long will this crash last. Let me first show you the comment. This is from somewhere, I don't know where, but Saba sent it to me, and great comment. So, 2 things I learned from my first bear market, the 2000 to 2002 slow motion crash. And I know that given my YouTube analytics, 90% of you haven't been investing, not even in the 2009 crash. So you've never seen a crash. That's why it's really important to see what can happen. Bear markets that follow lengthy bull markets tend to progress very slowly, as the culture of equity is deeply entrenched and there's an active buy-the-dip crowd fueling lengthy rallies. And that's exactly what we have seen in March, 10% rally, then from June to August, 17% rebound. We have seen a big positive rebound last week, 5%, and then immediately a crash down back to where we started last week. So this is the market, and there is so much buy the dip, and when the dip starts going up, there is so much money coming back into, which means that the crash that has just started practically down the slippery slope, and we'll discuss 5 factors there. And let's go to the second part of the comment. The bear market won't come to an end until the biggest of the glamour stocks have capitulated. Back then it was the big banks that were at the top of the S&P 500 and big tech names like Cisco, Microsoft, and those only started to capitulate towards the second half of 2001. More than a year after the bear market had started. Today, watch Tesla, which is still trading at an implausible 900 billion market cap. When Tesla has tanked, that will be a good sign of a market bottom. We also have cryptocurrencies and everything, so we have to see and wait, but let me give you an additional 3 factors that indicate where this market is going. So 3 factors explaining the comment, and let me start with the first one. The first one, that there is still plenty of money in the system, because if we look at what has been going on over the last decade, so much quantitative easing, so much money printing, and this 5 trillion piles that has entered the market with the central bank printing, it will take a long time for this to exit the markets, and therefore the bear market might continue for longer. Because if we look at the balance sheet just of the Fed, so this is a 4 trillion increase in a short period of time. And for this to revert, you can see that they cannot lower it, because if they lower it as planned, then the market goes down the drain. If we look at interest rates, those have just started to go up this year, just here, and they already expect them to just increase them a little bit, and then that's it, folks, and then bring them down again. So if they are forced to push them even higher because of inflation, because of them losing control, that's already something. So we still haven't seen the impact of this on the market, and this has been a decade and a half of crazy financial situations that will take much longer to clear out. Plus, I have friends that ask me, Sven, what should I do with my money in Credit Suisse? Are they going to bust? Will I lose it? Apart from that, I don't know what will happen to Credit Suisse, but it was usually the worst investment bank alongside with Deutsche, so that's something else. But the key is that people still have a lot of money with Credit Suisse, with Deutsche, with everybody. So there is still a lot of money that is still not destroyed given the environment. So the bear market might be just starting. Given the impact of the last decade, we still haven't learned who is swimming naked. When we start seeing who's swimming naked, and that might be ugly scenarios, then we will be closer to the core of the crash, but not yet at the end. Because if we look at the number of US bankruptcies, this is normal. Then quantitative easing started, no more bankruptcy, nobody is allowed to go bankrupt, and then pandemic, and now whatever you do, you will never fail because the government will give you money, whatever. So we haven't seen the zombie companies go bust and hit the economy because there are high debt companies, can only just service, just pay interest, depend on low interest rate, rely on bailouts. Credit Suisse cannot reduce principal of the debt, and too many of them undermine economic recovery. So there are plenty of these companies out there, a lot, and until we see them falter, then we will not see the end of this bear market. And who is swimming naked? The answer might be even delayed more if we see further bailouts, as every government doesn't allow bankruptcies anymore, which doesn't clean the market, which distorts the situation, which means that the next crisis, the next real crash, will likely be even harder than what it was supposed to be. We already discussed this. This is bailing out everybody. That's the key to understand. And the impact of this hasn't yet been seen. The money is still there, so we haven't seen not even the start. As we said, bailout, negative rates for everyone, and now we are just here. Let's see what happens when rates hit higher in Europe and then stay higher. Let's see how it impacts Italy, Spain, France, Greece, etc. And then we will just see where we are now in the stock market crash bear market. Plus, do you want a zombie? Look at this. Look at the numbers here. Deficits for the last 20 years, like there is no tomorrow, like those don't count. So maybe even the currencies will be swimming naked. We will see that, but the impact of interest rates that have just gone up a little bit on average, but if this average is, let's say here, 2% was in 2021, now it is 4%, not even, but let's say it goes to 6% because of inflation. Look at this pile of 140 billion of debt. The servicing, just the interest of this, goes from 3 billion to 10, trillion, billion, oh, crazy. But this is insane. And when 7 billion are out per year, everything, all the zombie companies and all the debt will crash. Another notion here to see how to make a problem worse. So 2007, this was a debt crisis, okay? Global debt was 75 trillion. How do you solve a debt crisis? To give more heroin to the junkie. Now the debt is double, so the crisis will be even worse. This is about the long-term debt cycle, which leads to the third factor that I want to discuss, and that is shocks, volatility, and inflation. Let me just show you this. This is the Dow Jones from 1968 to 1982. Down 65%. Can you imagine that this is in real terms, thus adjusted for inflation? Over 14 years, stocks have been down 65%. And since then, we have enjoyed the greatest bull market in history for the S&P 500. Of course, if you look at that period, till stocks return to normal 30 years, there have been plenty of opportunities to make money in between, so I'm waiting there for my copper, more safety, a few X, again here, big jump, so there will be plenty of volatility and shocks, but the big difference between this and back then, look at the deficits back then, even surpluses, but look at this. Even in great times, governments borrow like there is no tomorrow. When this start crumbling, when these zombies of governments start crumbling, there will be very, very ugly. So I would say there will be volatility and the markets might be down and the crash might last for the next 20 years. So that is also something to keep in mind when it comes to investing. So great comment. Thanks to Saba. Thanks for watching. A little bit negative video, but it's always good to understand what's going on and be sure not to be invested with those that swim naked. Thanks for watching. I'll see you in the next video.